All right, welcome to the next webinar, our live open home in our series for ready-built properties. Thank you very much for taking the time out to join us tonight. We're Green Shoots Property. My name is Scott Agate, founder of Green Shoots. We're a buyer's agency working exclusively for you, the investor. Every location decision we make is driven by data, not geography or a postcode loyalty. And tonight, you're going to see the full data case for our target market. So a detailed look at all 7 properties and time at the end, just to throw in any questions if you like as well. So let's get into it and let's get started. All right, so this is an overview of what we're going to cover tonight. Section 1, how Green Shoots property works. Section 2, the suburb and the data case. And Section 3, the properties overview. And then we're going to finish up with 4 and 5, which is 7 properties individually deep dived, and then that simple Q&A session at the end, of which we've preloaded a couple of questions in from our customer base who have bought some of these properties from us in this same location in the last 3 or 4 days. We've traded 3 of those, and we'll refer to those comparable sales through the process later into the slideshow. Cool. So before we get into the numbers, let's get clear about how we work, because it gives context to everything you're about to see. Green Shoots is a buyer's agency, a full-service buyer's agency. We work for you, the investor. So not the vendor, not the developer. Our fee, our full fee, or our payment here comes from you, the buyer. So it means our recommendation is never influenced by commission from the other side of that transaction. We charge $20,000 in total, so $10,000 up front, $10,000 once our client enters into an unconditional contract. That is transparently on the front page of our website. If you have a look at greenshootsproperty.com, you'll see all of our fees outlined there. Now, our market selection process runs through institutional grade suburb data that most individual investors, I should say, simply do not have access to. So if a market here does not pass the filter at suburb level, we're not going to get to the property level. So the suburb comes first. Once the market clears, we assess every individual property on configuration, on build quality, price against comparable sales, rental demand, long-term exit optionality, so many different filters. And you do not need to see the ones that don't make it through, because the third filter that we apply on top of that is then your equity position, your borrowing capacity, your tax situation, your individual time horizon. So we run these conversations one-on-one. We do not do group recommendations. What's right for one person in this webinar may not be right for the next person. So it's very much a bespoke process that we run. Now, let's look at some data-driven insights. Number 1, this is Melbourne that we're talking about tonight, 38 kilometres from the CBD. It's inside the urban growth boundary. It's on the Metropolitan Rail network with a direct 1-seat ride through the city since February earlier this year, 2026. It's not regional, it's not fringe, it's not a commuter gamble. Metropolitan Melbourne with a price point the inner ring simply cannot touch. Number 2, the product you're buying is the fastest growing asset in that suburb. 3 and 4 bedroom houses are up nearly 11% in the last 12 months. And this is not the suburb average. That is your specific asset class that's outperforming the broader market right now. Number 3, values have nearly doubled in a decade, and the market has never had a bad year. So 86% cumulative growth over a 10-year horizon, or the past 10 years, and it's compounding at 6.4% per year, which is really strong. The worst single year on record being effectively flat. It was 0.33% in the red. Strong growth with almost no downside volatility is the combination long-term investors spend your careers looking for, and you rarely find that in the same suburb. Number 4, right now, buyer demand is at the maximum reading nationally. So no suburb in Australia is being searched more intensely right now. So this is right at the top of the tree. And that is a leading indicator of where prices are heading, not a lagging one. Point 5, the independent data scores this suburb in the top tier in the country. So capital growth is rated 98 out of 100. Lower risk is rated 97 out of 100. Overall composite score is 93 out of 100 across more than 80 underlying metrics. It's a near perfect growth score alongside a near perfect risk score in the same suburb is what the filter is built to find, but it rarely does, right? So this is a standout. Number 6, it's a deep liquid market that sells fast and it's close to the full price. So, over 1,400 It's a huge amount of sales last year. So it's a big market. Homes are moving in just 26 days on average right now. So they're selling really quickly. And the vendors are achieving 98.5 cents in the dollar. So at exit, you're selling into a genuine metropolitan depth, I should say, not hoping, a handful of buyers show up. You've got plenty of buyer activity at exit if you need to. Number seven, the people who live here are exactly the foundation of a long-term hold needs. Median household income sits 9% above the Victorian average. Three-quarters of households are owner-occupiers, and nearly half of all families are couples with children. This is a settled, employed, family-orientated community that maintains homes, pays rents, and stays put long-term, which is the main thing. Now, point number 8 is that stock is tight and owners hold for a long term. Only 0.31% of dwellings are currently on the market, and the average owner holds for 8.5 years. That's against the Australian long-term average with households of about 7 years. So scarcity of available stock with strong and rising demand is the most reliable recipe for continued price growth. Point 9 is that tenants are stable and vacancy rates are low. Vacancy sits at just 2.36%, with a tenant base that's anchored in healthcare, education, trades, and government employment. Your property manager can begin marketing these things from exchange of contracts, meaning a tenant may already be in place by the time you actually settle. 10, the last one. More infrastructure is already locked in. The Metro Tunnel is delivered. Melbourne Airport Rail is under construction with a planned 2033 opening. Running directly through this corridor. Infrastructure already built is already reflected in values, and committed future infrastructure is not yet fully priced in. So there's a lot to like about this location. Slide 5. Now, this is the first of 5 sections tonight. The federal budget dropped recently, and there's been a lot of coverage about negative gearing changes. And I want to spend a few minutes on what actually changed and why it matters specifically to the properties you're going to see tonight. So from the 1st of July 2027, negative gearing on established properties has changed. If you buy an existing house and it runs at a rental loss, you'll no longer be able to offset that loss against your personal income in the year that it occurs. So, that loss can be carried forward, but it's a different thing to what most investors have relied on for decades. That's a meaningful change for established property investors. It makes the cash flow case harder and the tax benefit of negatively geared established assets less immediate. So new builds are explicitly exempt. Full negative gearing treatment is retained for these new construction properties now and after July next year as well. These properties are newly built. They're structurally on the right side of that policy change. So the policy didn't create this opportunity. The market was already compelling on the data before the budget. Now, we've been buying in this particular suburb for nearly 18 months for other customers into established houses. But it's that policy environment now that makes the structural case for holding a new build metropolitan property clearer and stronger than it ever has been. Second piece I want to address is yield, because in the current rate environment, it matters more than it has done in years. The RBA cash rate is sitting at 4.35%. The national average gross yield on residential houses is around 3.85%. That means the typical investment property in the typical suburb is running at a yield below the cash rate. That's before expenses, before management fees, before insurance, before rates, below the cash rate. That is a cash flow headwind that most investors are dealing with right now. And these properties are yielding approximately 4.17% gross, that is. And there's a bit of a range here, and we'll unpack all of that, but effectively from about 4% to 4.4% gross. And it's above the cash rate. So it doesn't make them cash flow positive on every scenario. It's going to depend on your loan structure, your deposit, your costs, but it changes that cash flow position meaningfully. So let's get into the location itself. If you can guess from the picture, you are a genius. It is Sunbury, beautiful Sunbury in Victoria. Now, I want to take you through the complete data case. It's not a highlight reel, it's the full picture. By the end of this section, you should understand exactly why this market made it through our filter and exactly what the risk profile looks like. Now, Sunbury is a metropolitan Melbourne suburb in the city of Hume Local Government Authority, 38 kilometres northwest of the CBD. It's not a regional market. It's not dependent on one employer or one industry. It is part of the Outer Melbourne Growth Corridor. It's serviced by Metropolitan Rail, connected to the city by the Metro Tunnel, and surrounded by an employment base that stretches from Melbourne Airport to Broadmeadows to the CBD itself. And we're going to walk through every relevant metric: population, economic base, growth history, analytics scores, market cycle position, supply, demand, infrastructure pipeline, blah, blah, blah. Every number you see is sourced from independent, verifiable, I should say, data. Nothing here is promotional, right? So it's all rigid-edge data. Now, population in Sunbury is 38,851 humans. The economy in the metropolitan Melbourne employment base is healthcare, education, retail, and transport. This is not a single industry town. The people who live here work across the metropolitan area, right? So the CBD, Melbourne Airport, Broadmeadows, Sunshine, and the growing Western Employment Corridor. The Metro Tunnel has delivered a direct one-seat rail connection through the heart of Melbourne. So no interchange at Flinders Street, no city loop congestion. That changes the rental demand equation fundamentally because the city of Hume is one of the fastest growing LGAs in Victoria. So demand for housing is driven by families being priced out of inner and middle ring Melbourne, essential workers in health and education, and workers at Melbourne Airport. It's one of the largest employment precincts in the state. This is a diverse, resilient tenant pool. Healthcare and education are particularly important here as employment anchors in this location. They're not cyclical either. They do not shut down when commodity prices fall. So the economic profile is the key reason the lower risk of 97 out of 100 is in play. So slide 10, let us look at the growth data because this is the foundation of the investment case. 1 year, it's up 8.37%. 3 years, 11.12%. 5 years, it's up nearly 28%. And 10 years, it's just over 85% growth. The 10-year compounded annual growth rate, as I said, is 6.4% per annum. The number I want you to pay attention to, though, is not the headline figure. It's the floor. The worst single year on record is approximately negative 0.33%, as I referred to earlier. It's effectively flat. So there's been no meaningful negative year in a decade, and that's really unusual. So most markets have at least 1 year of 5 or 10% contraction in a 10-year window. The 3 and the 5 year figures reflect really steady, sustained growth rather than a single spike. And this market has not been driven by a speculative cycle. It has been driven by infrastructure delivery, population growth, both of which are continuing. And a compounding rate of 6.4% doubles your asset value in approximately 11 years. So this growth rate is flying and it's well above the long-term Australian average. And these are historical figures, right? They're not guarantees, but the drivers underpinning them are structural and they're not speculative. Now, we use hashtag analytics as the primary data input in our suburb selection process. Institutional grade suburb scoring across more than 80 metrics. Capital growth, 98 out of 100, top 2% of all suburbs nationally. Cash flow, 84 out of 100, which reflects strong rental demand relative to price. And lower risk is priced at 97 out of 100. So most suburbs that score near the top for capital growth carry elevated risk scores. High growth and high risk tend to come together. This market scores near perfect on both of these scores simultaneously. And that combination is really uncommon. So overall, it's a 90 out of 100. It's the top decile nationally. The market cycle is positive. Growth is running modestly below, I should say, the long-term average, which means there's substantial headroom remains. And the data points to a market that's still in growth phase, not at its peak. So 2 things to cover off on this one. We're in the market cycle and what the suburb looks like. So market cycle position is positive. The market is growing without being overheated. It's got substantial headroom remaining before the market accelerates beyond that sustainable growth. We're not buying at the top of a spike here. We're buying into a market with structural tailwinds and room to run. Supply is constrained by the urban growth boundary and council planning processes. And this is outer Melbourne. It's not a greenfield corridor with unlimited land releases. So new housing supply requires planning approval, infrastructure contributions, and development timelines. The result is that population growth in this corridor consistently runs ahead of new supply, which is the fundamental driver of price growth in any residential market. The Metro Tunnel is still being absorbed into the prices. Infrastructure of this scale typically takes 5 to 7 years or so to fully flow through to median prices, and investors entering now are ahead of that full price discovery. The actual transaction evidence from the market right now. So days on market is just 26 days. It's flying. These properties are selling really quickly. So properties that sell under 4 weeks, that's active buyers and they're committed. So the vendor discount on those sale prices is just 1.52%. So vendors are getting 98.5 cents in the dollar. There's no distress here from the sellers. The vacancy rate, and this is the tenants that have been, or properties I should say, that have been vacant for more than 21 days, sits at just 2.36%. Tight enough that landlords have got pricing power, not so tight that tenants can't find anything at all. So it's a nice balance. Rent growth here is up 3% year on year. And if you're holding for the long term, which you should, the rental income trajectory matters as much as that entry yield. And this has seen strong rental growth over the last decade in Sunbury. Now, the infrastructure. Infrastructure is where the next leg of growth often comes from, and this market has just had the most significant infrastructure delivery in its history. So the Metro Tunnel is now open and operational. Sunbury passengers no longer change at Flinders. Southern Cross Station is under 50 minutes. Melbourne Airport is approximately 20 minutes by road and is one of Victoria's largest employment precincts. You've got aviation, logistics, hospitality, and all those associated services there. The Western Ring Road and the Calder Freeway provide road connectivity to the Western Industrial and that logistics corridor. Altona, Laverton, Truganina. This is one of the fastest growing employment zones in Victoria. A tenant here has got direct road access to those jobs without going near the CBD. So population growth in the city of Hume is council planned and infrastructure supported. The local housing strategy identifies Sunbury as a key growth node, and that is planning policy, not speculation. So before we get to the individual properties, I want to spend a few minutes on why ready built matters, because we hear a lot of interest in off the plan from investors, and I want to be direct about what that risk actually looks like in practice. Now, off the plan is not a bad investment strategy by definition, but it carries 4 categories of risk that deserve honest treatment rather than footnotes. Timeline risk. So we've got construction delays have been routine since 2021. A project quoted at 12 to 24 months regularly runs beyond that now. And your pre-approval expires, right? Your income or financial position may have changed by that time that you reach settlement. And you're locked into a contract on an asset that does not exist yet. So you've got valuation risk. The bank agreed to lend against 750 grand. The finished property, when the bank values it at settlement, comes in at, say, 690. You need to find that 60 grand from your own funds at short notice, or the deal falls over. And this has happened a lot in recent years, particularly in markets where off-the-plan supply was heavy. Next one is specification risk. Like, the renders and the finished product are completely different things very often. So finishes get substituted, common areas do not get delivered. By the time you actually inspect and find this out, you're already contracted. The next one is builder insolvency risk. This is not theoretical. Like, multiple major residential builders have collapsed mid-project in the last 3 years, leaving buyers in limbo for months or years, while legal resolution plays out, and it can go on for bloody ever. And we've seen like thousands of builders go to the wall since COVID, which is really sad. Now, I'm not saying these risks make off the plan impossible. I'm saying you should know what you're accepting when you take it on and you buy that type of asset. All right, so let's talk about ready built, because this is where I've pivoted a lot of my focus to post the budget changes, because the government is forcing our hand. So we still buy established properties for the right customers, but ready built is where I think the sweet spot sits. So it means all 4 of those risk categories that we've just discussed are eliminated straight away. So all occupancy certificates here have been issued. These are complete homes, right? They're council compliant houses. I've personally walked through and inspected every one of them in the last week. Now, you're not buying a render, so it's there. I can touch it, feel it, sniff it. The purchaser here uses a standard Victorian purchase contract. There's no construction contracts. It's got a Section 32 vendor statement. There's no sunset clauses. There's no construction completion risks. From the moment contracts are exchanged here, your property manager can begin marketing for tenants, right? So these are houses that are ready to live in straight away. And if timing aligns, your tenant might even be placed before or at settlement, and then your asset is income producing from day one, and that is the goal: more money in your skyrocket. Now, this is a beautiful picture coming up of me. I didn't do this on AI. I was actually there in Sunbury last week. So we've seen 7 properties to present tonight. You're going to see me outside all 7 of them in a second, and this range of properties that I saw was 3 and 4 bedroom homes across a number of different estates that are being constructed here, different price points and positions within this growth corridor. Pricing's already been negotiated on your behalf. I've negotiated all these deals as well as physically inspecting them. So a complete information pack, including like video walkthrough tours, floor plans, external rental estimates, full sales contracts, everything is done. You can just reach out, DM us, and we'll send you a pack on any particular house that you're interested in. So, as I said, there's my pretty face sitting outside Many of those homes, I didn't put that through AI. I was actually standing there and I've got the dirt on my shoes at home to prove it. Now, let's get into the properties. So I'm gonna get through these reasonably quickly. I'm not going to spend too much time because you can reach out to me directly and have a chat about this if you're ready and if any of this resonates with you. But 7 houses, I've deliberately chosen properties that range in square meters of size of home, the construction, plus the size of the land, different price points from low to higher, and different yields because everybody comes with us with their own bespoke set of financial models that they need to hit. So we can tailor this specifically to what you're looking for. But we've got entry-level properties starting from $620,000. The smallest block of land is 225 square meters, and the smallest house is about 16 and a half squares. The biggest home is 576 square meters of land, which is big, really big for modern master plan community estates. The house is massive, 30 square meters. And it's priced at 897,000, and that's got the weakest yield of 3.94%. And that's what you can expect. The smaller blocks of land, cheaper entry price, higher rental yield. The more you spend, typically, the bigger the block of land you get and the weaker yield you get. So in these master plan communities, many of the tenants don't actually want to maintain large blocks of land. So there is a balance here in buying for owner occupiers long term, and that's going to be your exit strategy, and also tenants that want to enjoy these properties with very low maintenance. Now, very specifically, I fought hard to find 7 properties that have been completely upgraded. So these aren't your bullshit cheap developer finishes. These have got upgraded floors. I'm talking like, hybrid timber floors and those types of things, or better quality tiles. They've got higher ceilings. They've got 2.7 meter instead of 2.4 meter ceilings, and some of them have got raked double height ceilings in living areas and other parts of the home. Some of them have got extended outside areas. They've all got undercover pergolas or al fresco areas, and some of them have got pergolas. They've got upgraded air conditioning, which is ducted. They've got better quality windows. They've got blinds inbuilt. So there's all different variations across the different houses. But all of these houses are beyond the base model, so they're much better. So what I'm going to present tonight, you'll have all that information, as I said, ranging from yields of 3.94 up to 4.27. And the thing that I want to explain to you about gross yield is that it's calculated, how we draw that number, is the weekly rent. We times it by 52 weeks of the year, and then we divide it by that set asking price. And that gives us a gross yield, pre-expenses, pre-tax, and you can speak to your accountant about what that net yield might look like after all of your fees, rates, and insurance. Every property that we talk about with you as a paying customer, we'll do a bespoke cash flow analysis so you can very quickly look at the numbers and determine what the pre or post-tax amount is per week to hold that property. So we're very, very detail oriented with the numbers. Now, this is 54 Redstone Hill Road. And again, I'm not going to spend a huge amount of money here. I'll get through these, I'll spend a little bit of time is what I was trying to say, to get through these ones. And then you can come back and fire off all sorts of questions with me privately if you want to get into the weeds. This one's $710,000. It's a 4-bed, 3-bath, 2-car, 294 square meters. It's a big home, 23 squares. Now, the rent I'm going to touch on really quickly here. So the agents are telling us 6 to 630. I've seen properties leased for 6 to 630 in the last week. We're very conservative by nature on the rents because when you're buying into these new master plan estates, there's often more choice. So we're very conservative, and this is a conservative 4.25%. This is a corner house. Redstone Hill Estate is in a really great development. You've got a huge community centre that's going to be open there in the next 2 to 3 months, and that includes things like pickleball or basketball courts, pool, gymnasium, and those things that the residents can get access to. There's already families there. You go there, there's established parks, beautiful tree-lined streets. People are living there and enjoying this location, and it's still very close to get back to the old Sunbury town and back to the CBD. So pictures here, you can see 40 mil stone bench tops. So these have got better quality stone, feature lighting, upgraded floors, higher ceilings, freestanding baths, all those types of things that I just mentioned. The floor plans are really clever. There's no wasted space in these homes these days, so you get a lot of bang for your buck out of the 23 square construction. Next one is 25 Apprentices Road. So 800 grand. It's a 4-bed, 3-bath, 2-car. It's on a bigger block, 400 square meters. The beauty of this one is it actually just leased. It leased yesterday for $630 a week, which was the high end of the agent's rental guide, and that gives you a yield of just under 4.1%. So this is something that you can bank on from day one, that there'll be income coming through. You can see the waterfall stone bench tops, upgraded floors, the higher ceilings, and again, a really good use of space. That extra size in this house, it's a bigger home, gives you a second living space as well. And the third one I just wanted to walk through was 7 Spaces Street. It's probably my favourite house that I saw last week. 897,000. They were after a little bit higher than that. I negotiated this down to sub 900,000, which I think is exceptionally good buying for this home. 4 bed, 3 bath, 2 car. It's an enormous 30 square home. It's on a very big, as I mentioned earlier, 576 square metre block. The agents are telling us $725 a week rent. I'm going conservative at 680, and that gives us a just under 4% return. Now, the beauty of this house is that at the end of this street is a small park, so you've got some outdoor play areas for families. Next to that is where a future school is going to be built, and next to that, currently in construction, is Woolworths, a swim school, and some other commercial assets that are mid-construction as well, and no doubt will be open in the next 6 to 9 months. So there's a lot happening in that estate, and all within walking distance of that home in Spaces Street. The other thing to note is it's surrounded by other really big houses on big blocks of land. So I would imagine in future, this is going to be a predominantly owner-occupied street and location within that little estate. Let's have a look at the photos here. So this house is so cool. So that it's got 2 master bedrooms, one at the front, one at the back. The Jack and Jill bedrooms, so bedrooms 3 and 4, are connected by that bathroom that you can see with the double basins. You can see it's got the heated mirrors. That is a luxe bathroom for your kids to use. Double basins, freestanding shower and bath. The kitchen's got a full second kitchen. So there's another, in the butler's pantry, another double sink and another cooktop in there as well. So this has got an extended al fresco where you've got a pergola. It's got a massive front lawn. It's got a massive grass lawn, flat lawn is what I was going to say, which is great for families. This is just a really nice high-spec house, and it's a really good pocket of that market. Now, comparable sales evidence, because you want to know that I've actually looked at what these things sell for and negotiated the right prices. And I've actually physically just bought 3 properties there in the last week. So for other clients of ours at Green Shoots Property, we've just bought 14 Goshawk Road, which is in the same estate as that Redstone Hill property at 710 grand. This one was a 422, 718,000 we bought this for. It was on larger land than the Redstone Hill property. It's on 350 square metres of land. Also had all of the upgrades. We bought 6 Rockin Road, 422 on $745,000 purchase. It was on a bigger block, 386, corner position, really nice and light. It had significant upgrades to that property as well, and one of the top tier builders locally. And we bought 17 Lollipop Crescent, which was a bigger house, 4 bed, 3 bath, 2 car, substantially bigger home on a much bigger block on 421 square meters. And that commanded the premium at 826,000. So us personally, we've got, first-hand knowledge of what these prices are going for and the value proposition of those properties that we've got in front of you today. So as a full service buyer's agent, we manage every step of the process, right? So you're not doing this alone. Step 1 is a one-on-one conversation with me. We're going to talk about your equity, your borrowing capacity, your portfolio fit. Step 2 is going to be talking about finance pre-approvals. If you do not already have one, we can connect you up with the right broker that's experienced in investment lending. Step 3 is a contract review. So, we're going to facilitate an independent solicitor to review the Section 32 vendor statement and that purchase contract before you sign anything at all. And then step 4 is a building and pest inspection before you exchange contracts. I want to know the condition of these properties before I enter into that contract. It's just another way to de-risk investing for our clients. And step 5 is exchange of contracts. So once you and your solicitor are comfortable, the inspection is clear, contracts are exchanged, the property is then secured. And then we'll move through to the settlement process where we'll find a property manager that you're happy with to engage and find this tenant to make sure that rent's coming in from day dot. And we're going to present you with 3 of those local property managers. We're going to benchmark all their costs head to head, and then we'll guide you on who to use. And they can start marketing immediately, and we want to get that rent coming in. So here's that 6-step process. You can see that is nice and straightforward, and that the entire thing is managed for you end to end. So Q&A. So we've bought, as I mentioned, 3 of these properties in the last week. Some of the questions that came out of that I thought worth unpacking here tonight. And if you've got any more questions, throw them in the chat. But one of the main ones was why out of Melbourne and not inner ring? And that's a really good question from one of our clients. So worth unpacking tonight. So this is a great question. And I think the data answers it really clearly. So a new freestanding 3 or 4 bedroom home in Melbourne at 700-800 grand, it doesn't exist, right? You're looking at 1.2 million plus, massively plus, plus, plus. The yield then collapses to 2.5% to 3% if you're lucky, and you're deeply negatively geared. It's dependent entirely on capital growth with zero cash flow buffer. At this price point, you're above the national residential average yield of 3.85%, above the RBA cash rate before the tax benefits of depreciation and deductible expenses are even applied. So the connectivity argument has also changed materially. The Metro Tunnel has delivered a direct one-seat rail connection through the heart of Melbourne. Southern Cross Station is under 50 minutes. It's competitive with many inner south and inner east suburbs. So on capital growth, that 85.96% over 10 years is so strong. Many suburbs closer to the city have underperformed that figure in the same period. The growth driver here is structural. So population growth, infrastructure delivery, supply constraints. It's not speculation. The negative gearing changes from the 1st of July affect those established properties as well. So these new builds retain that existing tax concession. It's another reason why we're here. And a buyer who purchases an established property after July next year is going to lose that immediate offset. So these properties are exempt. So what if the property sits vacant? Well, the vacancy rate here, as we've discussed, is 2.36%. So the current measured rate, it's not a projection, it's fact. Vacancy at that level means the rental market is really balanced. Landlords have got pricing power without instability that comes with extreme tightness. Rent growth has been really positive. It's at 3% year on year, and it's driven by genuine demand at current and rising rents. The rental demand drivers are structural again. The metro commuters who want city access without those inner ring rents, families priced out of those closer in Melbourne locations, and essential workers, right, in healthcare, education, and Melbourne Airport, and the workers in that Western employment corridor. Now, this is a diverse tenant pool. It's not dependent on one employer or one industry. And Green Shoots will present you with the 3 leading local property managers before settlement, as I just said, and we'll evaluate that on the vacancy rates, the rent achievement, and management fees. Final selection is completely yours, but once engaged, they're going to begin marketing for that tenant right from exchange. Question 3, who's going to buy this off me when I want to sell it? It's not a question a lot of buyers agents even want to sort of disclose because they're focused on being transactional, but this is part of the advice piece for us. It's understanding, okay, well, if I go buy this asset now, who the hell is going to buy this off me when I need to sell it? So you've got more exit options here than most out of Melbourne locations are going to offer. First, you can sell to another investor, right? So a new build with full depreciation remaining and a proven rental yield in a metro Melbourne location is a straightforward investment case. Secondly, you can sell to an owner-occupier, right? This is a genuine family suburb with strong demand for quality new homes, and it's got city rail access. Thirdly, you can just hold and refinance, right? Your equity builds quickly at this price point. It's in a corridor with growth history. And many Green Shoot clients are going to use this investment property as an equity base to fund their next acquisition. Now, whether that's their first property leading into a second or their fifth into a sixth. Now, the fourth point, population growth here expands your buyer pool over time. The City of Hume is one of the fastest growing LGAs in Victoria. The key question for me is not who's going to buy it, it is when you want to sell and what your financial position is going to look like at that point. Question 4, is this a short or a long-term hold? This is a long-term hold, and the data profile supports it fully. The metro tunnel infrastructure effect on prices typically takes 5 to 7 years to fully absorb. Investors entering now ahead of that for full price discovery. So the overall score, the data score of 90 out of 100, reflects a market that performs consistently over time. It's not one that spikes and resets. The worst year in a decade was negative 0.33%. That 10-year growth of nearly 86%. These are the characteristics of a hold, not a trade. And this is a capital city market, which a lot of my customers are really comfortable with. The negative gearing changes from next year make a long-term hold in a new build more valuable relative to established property buyers who lose that immediate offset balance. Review exit timing with your accountant or your financial planner based on your broader portfolio and your income position. And any of our clients, they know that we're consistently tracking the value of these assets. And at any stage, we can update you on what your equity position actually looks like and what the conditions or market conditions are, whether that encourages a sale or a hold. All right. one of the last points I want to talk about. So, as part of our process as a buyer's agent, we use portfolio planning software to model out your situation to achieve your long-term goal. And I want to quickly show you how we do it. So this is the planning software every Green Shoots property client, easy for me to say, gets access to. And it's built around your numbers, right? Not generic projections. It starts in the portfolio tab. You load in everything you own, right? Like the platform shows your total growth, the compounding annual rate, the current value, the loan to value ratio, your equity position, and exactly how much of that equity you can access and deploy into your next move. And from there, we move into the plan tab, right? So you set a passive income target. Let's just say it's 100 grand, right, in retirement. And the platform inflation adjusts that number out over your timeline. So you're working towards a real figure, right? It's really important, not a false one. And then we start building the portfolio around it. And at each step, you can see exactly how much closer you are to closing the gap. You're not guessing at what you might work or what might work, I should say. You're running scenarios with your actual numbers until that picture is really nice and clear. And then there's the brief page, right? So it's a live calculator where you can stress test any purchase before you commit. Change the rental yield, change the loan structure, flip from interest only to P&I, adjust the deposit, whatever you want. Watch the cash flow position shift in real time. So you've got 3 tools on this one platform. And if you want free access to this, we've got a specialized link here at Green Shoots, which we'll put in the chat. And you can just go in there, you can plug in all your numbers, you can play around with it. This is a fantastic tool to use. And it's a really great way to ensure that you're, I guess, reverse engineering your overall financial goals and you're really clear in your decision making to achieve those goals. So, thank you for being here tonight. That kind of concludes where we're at. If any of what you've seen fits your situation, the budget, the timeline, our approach, the next step is a really simple conversation with me. So it's not a commitment, it's not a deposit. It's probably a 30-minute call is all it takes is to work out whether this is a fit for you or not. And of course, this isn't the only location that we're buying. So if you like the methodology behind this, if you like the detail that we go to in terms of the data-driven approach that we take, but you want to look in different states, you want to look in different price points, you want to look at a different size property or a different yield property, just ask. This is what we do. We've got locations right across the country. What I'm doing is featuring what we believe are really incredible opportunities that fit within this GSP Ready Built framework, but there's always other options that are bespoke to whatever your specific needs are. So book a time with me directly via the link in the chat. Thank you so much for your time. I appreciate the opportunity to present this information. I know this is going to be a really great pillar of some of your wealth creation moving forward, and we'd love to work with you to find the right fit. So have a lovely night and thanks for your time.